We've got Gautam Shah, CMT founder and Chief Strategist at Goldilocks Premium Research, joining in on the show right now. Gautam, hi, good morning. Great to have you on the show and wish you a very happy new year from all of us here. Gautam, just wanting to understand, it's quite a, tug of war, if you will, between the Bulls and the Bears. Who's going to win?
Good morning, Aisha. Happy New Year to you and all your viewers. Yes, I think you described it very well. It's a tug of war between the Bulls and the Bears. In fact, the last 1 week has been a little uncomfortable for me because whenever I'm invited on business channels, you end up talking good things as you started the new year. But as a chartist, as a technical analyst, when I look at the evidence on the table, I just get the feeling that 2023 is going to be a challenging year for the markets. Because I think what has happened in the last 4 to 6 weeks is a sort of a transition phase from an uptrend to a downtrend. And I think the kind of price action that we've seen in the last couple of weeks, it just tells me that the bears are taking control by the day. So we don't have any positive triggers at this point. And I think the manner in which the Nifty has come back to levels of 18,000 just suggests that the entire market setup is weakening. You know, the leadership is gone. The momentum on the upside has just not been there. The pullback that took place from 17,800 to 18,250 look very fragile. Global markets are not in the best space. Gold and silver are suddenly doing very, very well. So I think once 17,800 breaks on a closing basis, which I think could happen eventually, you could see a large dip of about 5, 7, maybe even a 10% decline. So these are times for capital protection. These are times to be slightly conservative. And I think there are just too many stocks and too many sectors which seem to be headed lower. So unfortunately, for the first time in a year, we don't have a positive view on the markets.
Yeah, that's quite the negative view, if you will, you have. Okay, let's talk about one of the largest composites then, right? Banks and financials at large, let me put it that way. Given the breakdown that you had in Bajaj Finance and FinServ yesterday, news-based move regardless. And then, of course, you know, the kind of dichotomy that you've seen throughout the year within what ICICI Bank and SBI have done, what an HDFC Bank and a Kotak have done, and then the, sort of emergence of IndusInd Bank and Axis. Gautam, help us understand what the big boys from within the financials are going to do next.
You know, the Bank Nifty has really led this entire market higher in the last 1 year. I think it's been the poster boy, it's been the Pied Piper, it's been the reason why the Nifty scaled to levels as high as 18,900. But I just feel that all the positives are now in the price. So all of these top performing banking stocks like an ICICI or a SBI or an Axis or an IndusInd, they have been going through a sort of a distribution phase in the last 1.5 months. And the Bank Nifty itself, the fact that it refused to get past that important resistance of 43,500 a couple of days back is an indication that even this index is ready to fall. Any which way, all other sectors are already weak. Apart from metals, if you look at the IT pack, look at Reliance, the consumer durable space, the FMCG space, they're all very weak. It's just banks that was holding the market. And with this move of the last 2 days, and if the Bank Nifty were to break the 42,000, 42,500 support, I think it could see a much larger dip. In fact, just yesterday we gave a sell call on some of the top banks, and we feel that the trending move has already started. So banks are not a place to hide. I think the only two places to hide at this point of time is capital goods and possibly PSU, PSE as a basket. So these two places look okay, and maybe pharma, which I'm expecting to, run up at some point of time. But most other sectors in the market are weak at this point.
You pointed out metals. Now metals is high beta. For metals to do well, the economic trajectory has to be different, the landscape has to be different. So at a time when your overall view is bearish, your view on metal is quite constructive. That's a rarity, isn't it?
It is. We've been trying to answer this question ourselves in the last 7 days when we speak to clients, because metals are known to be high beta, as you rightly said. They are seasonal. I don't see this as a structural rally. It's just that the metals index is one of the few indices to trade at lifetime highs, as the Nifty has come off about 1,000 points from the recent high. So it could be seasonal, it could be just temporary over the next 2 to 3 weeks, but I'm definitely not saying to hide in metals. I'm just saying that for the short term, there could be some momentum, and there are some stocks that could stand out like a JSW Steel or a Tata Steel. But I wouldn't really, go beyond looking at more than a few weeks. So as I said, it's more seasonal. I think if the Nifty were to break 17,800 at any point of time, even metals would come under pressure.
Divide the market in three compartments. Compartment number 1, book profits. Compartment number 2, hold. Compartment number 3, short. Rather than doing a sectoral classification, let's do a strategy-wise compartment. So compartment number 1, book profits. What qualifies here?
I think a lot of stocks qualifies here. I think all those stocks, which were the poster boys of the last 2 years and which gave stellar returns, we are recommending clients to take profits there. Even if you miss the bus a little, and even if our view is wrong, it's okay to come back higher because we need the Nifty to get past 18,300 for any sort of positivity on the screen. But the way we see the Indian markets, I think we are strongly recommending profit booking, and we are recommending shorts very selectively. If you look at a Bajaj Finance, Bajaj Finserv, look at a Trent, look at how ICICI Bank is shaping up, look at a Naukri. So there are some names which are aggressive maybe. So some of these stocks are setting up on the short side, and every passing day, more and more stocks are, fitting the bill. So as I said, hold is something which I would recommend in very selective mid caps and small caps, which have already seen so much downside in the last 1 year. So there is not much scope. But the way I see it, it's basically top quality, and companies with very richly valued companies are the ones that could come under pressure. So Asian Paints comes to mind right there.
IT will be a avoid, or at some point in time you would say that, look, it was a damaging 2022. At some point in time it becomes a contra buy. How far are we away from IT becoming a contra buy stroke and oversold zone?
See, I want to be optimistic on IT, but the problem is the kind of global headwinds that we're living in, the kind of dynamic world that we are living in. I just feel that even IT might just crumble because you can't have the Nifty falling, say, 5, 7, 10% and IT holding out at these levels. So for me, 28,000 is clearly the line in the sand for the IT index. If that breaks, there could be, some more downside. But still, on a relative basis, because most of these IT stocks have already down 40, 50% from their October 21 highs, I don't see significant downside in them. So if you really want to park your money in steady stocks, where you will not get washed away, I think that would be Infosys and TCS. But mid-cap IT, avoid, apart from a couple of names like maybe a Persistent or a Coforge, which we like and we've recommended, all other stocks are an avoid.
Mid-cap IT can be looked at, and I just want to stretch that point forward. You're talking about right now your view on the index being that if we break 17,800, there's more downside in store, 5 to 10%. So in that light, then would it make more sense to look at select stocks within the mid and the small caps? And if so, what would that be?
It's been quite a disconnect in the last 4 days because, markets have come off. The screen hasn't looked good on the large caps, but the mid caps and small caps have held out quite well. Because if you look at the breadth data, already so many mid caps and small caps are already languishing at 52-week lows. It's just the quality mid caps and small caps which have been holding out in the recent past. But if you were to see a trending fall, over the next few weeks to few months, then I don't think mid caps and small caps are going to stand out. So what we are doing at Goldilocks is we are recommending people to stay with the industry leaders, whether it's large caps, mid caps, or small caps. That's how your portfolio is going to be protected. For example, if you're looking at the unlocked trade in the mid-cap space, I would rather be with an Indian Hotels than a Lemon Tree. That's how we are positioning ourselves. And we also want to be in value. We want to be in the PSU space, the PFCs and the RECs and the ONGCs of the world, where we know that the downside is just not there. The dividend, yield angle kicks in and it's under-owned. So I think that's the kind of space that we like for the next few months at least.
Gautam, if 18,400, that congestion zone is conquered, then are we looking at 19,000, 19,000 plus? Because the stiff resistance of 18,000 is not like a distance away. It could be a 1 week's work.
I know, and that's the reason, Nukunj, I said that the last 2 weeks was a transition phase. Now, it seems as if this transition phase will turn on the downside, but we just have to wait and watch. My numbers are very clear. If the Nifty gets past 18,300, I will change my stance. I will review the market differently. And, we will come back in with all the aggression that we had on the bullish side over the last 15 to 18 months. But it's just the evidence on the table that does not allow me. The fact that the markets are trading below the moving averages, the Dow is precariously placed just above 32,500. Global markets are not in a great shape at this point of time. So yes, above 18,300 will come back in. But as I said, the evidence hints at a breakdown below 17,800 eventually.
Now, slightly medium to long term questions. For 2023, do you think more money would be made by going long or by going short?
A mix of both, Nikunj. It's just been buy and hold quite easily for the last couple of years, to be honest, whether it's large caps or mid caps. But 2023, I think, might just be all over the place because you are going to see moves of, say, 1,000, 1,500 points quickly and then also rallies, of that magnitude. So I think it's going to be more of a trading market. And if I have to give you a sort of a big range, 16,000 on the downside and 18,500 on the upside, I think it's entirely possible that the market trades in this entire band the entire year. I know it's too early in the year, but that's what this looks like. But then for your viewers, the bigger opportunity, as I see, and we've recommended at Goldilocks, is gold and silver. I think precious metals could really rule 2023, and I wouldn't be surprised if both these commodities go on to hit new lifetime highs.
Okay, really appreciate your time and have a wonderful 2023 ahead.